Let me now bring on board Hiren Ved, Director with Alchemy Asset Management, to talk about his current market view and where he thinks markets are headed. Hiren, looks like markets are stuck between rock and a hard surface. For the first time, the bears are saying that we've not lost the battle.
Well, Nikunj, I don't think so. I think, I think we've had a phenomenal rise from the lows. And, it's important that markets consolidate the gains that they have made. Nobody expected that the markets would bounce back so aggressively. In fact, if you look at the data of mutual fund flows, right, it's very indicative of the fact that the investors have been selling ever since for the last 7 months, because they think that markets have run ahead of themselves. They want to book profits. They want to keep cash on the sidelines. No market tops out when you have 7 months of consecutive outflows. You can argue that some of that is being invested directly, but my feeling is that the market's just catching its breath after a phenomenal rally.
So what is the best way to approach this market? Because if you know markets are headed higher and the economic cycle has started, so we definitely would be higher in 6 months' time and a year's time. Should one just wait it out, digest the volatility, ignore the daily movement? Because if you sell now, you may not get a chance.
No, absolutely. I think we've been telling investors that, do not wait for, making your investment decisions based on Nifty, right? I think what we saw was a classic first move of a bull market, where the markets kept climbing the wall of worry. It is only once that move matures that people start to understand that it is not just a liquidity-driven rally, but there is an earnings support, there is reforms that's happening, that the economy is rebounding. I think I think to make money in this market, you need to take now a very strategic, 2 to 3 year view at least to begin with. And I think if you do that, I think every intermittent correction that we are seeing right now should be used as an opportunity to get into the market rather than trying to time it. And you're absolutely right. If you try to time this, you're going to be left behind. But let's also be very clear that when you have this kind of a rebound, it's quite possible that there may be extraneous factors that come in between, which can lead to a sharp correction or a drawdown, right? I think we are so lulled into the fact that we've never seen a 5% plus correction on the Nifty. I mean, in the good old days, 8, 10%, 15% correction used to be a normal correction, right? So I think we should, go ahead with the fact that the markets could correct anytime. It's in the nature of the markets to correct. But I think I see a very, very bright future, both for the economy and for the markets. And the best way to play it is to stay invested or use every fall to invest in the market.
Hiren, you always like to buy themes. So give me your best 2 themes, and not the headline themes like consumption or something on manufacturing. Give me with specific themes where you feel that for next 2 or 3 years, a 15 to 20% growth is not a probability but a possibility. I'll say it again, not a probability but a possibility.
So Nikunj, I think that to some extent I feel we are, though every cycle is different, I think we are in a 2003 to 2007 kind of cycle, right? And I think that manufacturing is going to make a comeback. The economic cycle is likely to revive dramatically. And therefore, there needs to be some cyclical element in your portfolio. But if I were to use one word, which I've been saying since early this year, is that everything that is digital and cyclical will do well, over the next 2 years. Because and therefore, I think that IT services or tech, as we call it in India, is likely to do extremely well over the next 2-3 years. I know people have spoken about it, but I think that people are still waiting for the confirmation that that IT industry is on a structural tailwind. And I think maybe this quarter and another quarter will convince investors that we are indeed on a structural tailwind as far as IT is concerned. And then all the sectors that didn't do so well, like autos, auto ancillaries, right? The cyclical sectors, even for that matter, metals. Generally we don't invest too much in metals. I think the last time I did that was in early 2002 when we bought Tata Steel. And I think the time has come that we should pay some attention, at least a small allocation to some of the so-called cyclical sectors that people have been avoiding for a long time. But, even without playing that, you can easily, there are other sub-themes like logistics, for example, or, you could look at autos, auto ancillaries. I think good quality companies there, leading companies there, will give you very good returns over the next few years.
Hiren, what according to you are the key pressure points? We've also seen the index, change its constitution over the last few months in particular. What going forward to you are the main pressure points, given that the economy is still wobbling back to life? I mean, all the recovery triggers have been, positive, but it's still a little uneven and will probably still take a couple of quarters to fully bounce back.
So I think the pressure points come from the fact that, we are experiencing some sort of a second wave, which is kind of going to a little bit hinder, again, the movement of people, though I think we're not going to experience anything like the lockdown that we experienced, in the early part of the pandemic. And also the confidence comes from the fact that we now have our own domestic vaccines. So I think hopefully by July, August, most of us, will get vaccinated, and therefore the recovery should gain hold. But I do believe that there are opportunities in sectors, which were more impacted by the pandemic, right? And I think those sectors could revive, whether it is hotels, airlines, discretionary consumption stocks. So many of them have not moved beyond the pre-COVID highs. So I think this year there could be an opportunity, maybe to some extent, the recovery could be delayed because of the second wave. But I think eventually it is likely to happen because, the big strong point about India is that we have our own vaccines. We don't have to wait for vaccines to be imported from another country. To that extent, we are lucky, and probably 2 or 3 more will get approved over a period of year. So I think, yes, the recovery is still uneven, but it's going to be, like they say, it's going to be a tale of two halves. I think it's going to be a tale of 2 years, right? So you have 2021, which got substantially impacted because of pandemic. Certain sectors didn't get impacted. There are certain sectors which got more than disproportionately impacted. They will benefit in 21-22. So I think you will have to, in many senses, take a block of 2 years, which is FY21 and FY22, because some businesses will probably recover in the forthcoming financial year, because they got more than disproportionately impacted last year.
Absolutely. Hiren, I know you said it's time to look at some of these other pockets, but on IT and a sector that has performed so well, continues to, and also continues to be very optimistic going forward, what would you suggest is the best strategy? Maintaining, some amount in your portfolio, would you call it any longer a defensive play? Or would you perhaps suggest going further into some of the mid-cap names in IT, trying to find further value there if you're too late to enter some of the more expensive stocks? What would you suggest is the best strategy for an investor still looking to get into the segment?
So, I think with the new tailwinds in the IT sector, traditionally, I've always heard, that IT is a more defensive sector. That's because growth rates over the last couple of years were moderate. But the defensiveness of the nature came from the business model, the strength of the balance sheet, the cash flow generation capabilities. And it was also a great hedge against any macro uncertainties, which generally leads to the depreciation of the currency, and you tend to benefit. But I think going forward, the benefit of being invested in the techs in IT is that it is both aggressive and defensive. I think it retains its defensive nature because of the quality of the business and the balance sheet and, the kind of cash flows and return on capital that these businesses generate. And it is offensive because I think structurally growth rates have gone up. So if you're looking for growth, quality growth, I think you will get it in the tech sector. And I think absolutely, I think we are bullish on the large cap, but we are also bullish on very selective mid caps as well. And I think there are opportunities across the sector. We believe, we've had a very strong exposure to the ER&D segment, which includes stocks like Tata Elxsi and L&T Technology Services. But we also have exposure to large caps like TCS, Infosys, and LTI and HCL Tech. So, we continue to be very, very bullish on the tech sector, both across large and mid cap.
So, Hiren, with the exception of staples, looks like you are bullish pretty much across the board. You like metals. I know you own pharma. You have a constructive view on metals now, something which you've not bought in a long, long time. So, on the aggregate, you are quite constructive across the board.
Yeah, I think Nikunj, I'm quite bullish. What you will keep seeing in this market is what we call a sector rotation, right? So, people have been kind of chasing sectors, but I think that we're going to see a broad-based recovery. The beauty is that we're going to see not only recovery in India, which means that there is likely to be a very solid recovery in economy-facing stocks in India, but because global growth is so strong, you will also see globally aligned export-oriented sectors also do very well, whether it is auto ancillaries, whether it is IT services. And in pharma, you have to be very stock specific, right? So I think I pretty much, I think that if you look at the next 3 years, and we have a very constructive view on markets, we also have a very constructive view across sectors and across market caps. I think both, large, mid and small, everything will do well. The breadth of the market is likely to improve. I think we are moving away from a situation where in 2019 and early part of 2020, we saw the markets had become extremely narrow. In fact, in my 30 years, I've never seen a market as narrow as it was in 2019, where only a few stocks did very well. Obviously because we were reeling under, many issues, right from ILNFS to DHFL, the whole credit system had got frozen. But I think now that has changed and you will see a better breadth of opportunities going forward. So, I'm pretty much bullish across the board. And I think it's going to be back to stock pickers, for the next couple of years.
Fertile hunting ground for you is always companies which are in the market cap of $2 to $5 billion. they're decent in size, they have a track record, and they're liquid enough for you to buy and invest into them. So within that fertile hunting ground of $2 to $5 billion market cap, where are you picking your spots, and where you think that this market has scope for both earnings upgrade and PE upgrade?
So I think, Nikunj, when you talk about the $1 billion to $5 billion kind of market cap, I think there are opportunities in engineering and capital goods companies. There is opportunity in auto ancillaries. There is opportunity in mid-cap pharma. There's opportunity in mid-cap tech. There's opportunity in logistics. So, I mean, there are several subsectors. So, I kind of go, when you go down the market cap, you have to be very, very company specific. So I think we are seeing a lot of opportunities, across many of these businesses. I think, and on the large cap side, if you want to go more cyclical, then the best thing to do is to buy, the largest metal companies, or, for example, I think Tata Motors is a classic cyclical, right? I mean, in every cycle, it gives you a 5x to 10x return from the bottom. And I think this time, the business is far better positioned than, let's say, it was in the previous 5 or 7 years. The firm is so I think, I'm just using that as one of the examples, but I think that there are opportunities across a wide variety of sectors, including some of the new age sectors like electronic manufacturing, etc., where we see a lot of opportunity. Specialty chemicals is another area where you could do hunting on mid caps.
Right. Hiren, the mark of a good investor is not just to know what to buy, but it's also what to avoid. What is it that you would steer clear of right now? Because, the question really comes from the question marks on banking and financials right now. Many believe that the moratorium is still pretty much a sword hanging on the neck, and a little wary about where banks and financials may be headed.
So I think in general, banks and financials, despite all the headwinds that we've seen last year, seem to come out very well, especially the leading companies, right? And I think that, I think from what they expected, what was expected early on, that the level of credit costs that could hit the system is far lower in terms of what we will now see actually. And therefore, most of these banks and financial institutions have provisioned themselves adequately and have raised capital. What could therefore happen is that, when you raise additional capital and you've provided for it, maybe for you to generate that return on that extra capital will take a little bit longer. So maybe the recovery could be prolonged a little bit into the cycle. But I think the worst is, is clearly behind us as far as financials is concerned. I think there I would say that, it will be quite interesting that we should be able to see more consolidation in the sector going forward. I think if genuinely we are able to privatize some of the PSUs, right? And, then I think you will see a flurry of activity, where some of the very well capitalized larger banks could end up, playing the consolidation game. Or we have to wait and see whether industrial houses are allowed to own banks, in which case we will again see a re-rating in the small and mid-cap banks. But other than that, I think, we would prefer to stay with the more larger names in this area and not venture down. We have to just wait and see whether indeed we are able to move ahead on any of the public sector bank privatization that, that is upon us.
other spaces, sectors or themes that you would steer clear from?
Nothing really. I think there is opportunities across the board. I think obviously, you need to be very careful that you don't want to be invested in highly levered companies or where you believe that, there is an event risk that leverage won't fall. And obviously, you got to steer clear of businesses where return on capital on a structural basis is far lower. So I think you should stay clear of that. Secondly, I think, I wouldn't say stay clear, but I would say that, there are segments of the market which got the benefit as a result of the massive uncertainty that we saw both in 2019 and 20. And I think those very high PE stocks, though they are great companies, I think they could move sideways for some time and not deliver the kind of incremental returns that you would get from the broader markets. So one has to be careful because, markets are cyclical, right? And even though these are structural growth stories, but I think many of them got the benefit of, expanding PE multiples and the fact that most of the money was hiding there. So I would say that, one needs to look at, again, each investor is different, each investor's risk profiling is different. But I think that, the very high PE, high quality, which is where all the money was hiding, I think some of the stocks, not all, but some of the stocks could go into a fair bit of consolidation phase and not deliver the kind of incremental returns that some of the other stocks in the broader markets could deliver.
Hiren, which is the so-called internet company you would bet on? Nazara has gone public, Zomato is planning to go public. There are a lot of internet companies which will go public this year, and that's a new segment which is getting created. Are you waiting for a big name, or have you already identified which is one portfolio internet company you will buy?
Nikunj, there aren't any pure play, B2C internet companies so far. We do have some exposure to InfoEdge because that's what gave you the exposure to many of these names. But, we'll have to wait and see, which of these is a sustainable business model. And secondly, what valuations you want to pay for a business like that, right? So yes, indeed, there is a lot of opportunity. But if these companies go IPO at very euphoric valuations, I would rather wait and watch, because it's not as if that the internet is going away tomorrow. And if I don't, invest in these businesses, I'm going to be left behind, because markets gives you chances. So if, certainly is there interest? Without doubt. I think there is great opportunity in many of these internet businesses. But, if they come at, very crazy valuations, then I would, rather applaud from the sidelines than participate. Because markets will give you chance at some point in time in the future.
There are two stocks, Hiren, which I'm sure you take a lot of pride and you say, look, I bought them and it created wealth for my unit holders or for my investors. One is Bajaj Finance and second is Trend. Now, whichever traditional metrics I use, price to book or P multiple, or even for retail companies, if I look at enterprise value, they are expensive. So where are these two stocks headed, Trend and Bajaj Finance, in next couple of years?
See, Nikunj, I think, both of them are great businesses in their respective fields. Bajaj Finance has proven again and again that they've been able to weather all challenges. And the one that we saw during COVID was the mother of all challenges that they could have probably seen in their life cycle. I think they've done reasonably well to manage that challenge, and they are on course for a complete revision of their business model. They, obviously, the management has said that, we are going to unleash Bajaj Finance 3.0, which is going to be more agile, more digital. And therefore, I'm quite confident that into the future, over the next couple of years, this business can still generate significant returns for investors because of the simple thing that in every few years, the company has been able to reinvent. It's very agile. And secondly, if you look at the absolute size of the balance sheet, what are we talking about? We are still talking about 1.6 lakh crore balance sheet size, which is nothing compared to, what many of the other well-run, retail franchisees are. And therefore, the headroom for growth is very, very significant. Yes, the valuations are expensive, but that premium valuation the market has given historically for, for very strong growth and the quality of execution year after year. I think growth over the next few years may not be the kind of hyper growth that we saw, which is like 40-45% growth. But can the business still grow at 25-30%? I think it can. And as far as the management is concerned, it continues to be top class and they continue to execute extremely well. So I see no reason why the business should not continue to command a premium, though I think in future over the next few years, the company might decide to moderate growth a little bit than what it has done in the past, but we'll have to wait and see. As far as Trent is concerned, it's still a very young company. And as we've seen in retail, that very few businesses actually make it because retail is a very, very tough business, right? So if you have a format to make it profitable and to make it scalable is extremely difficult. And I think Trent has shown that. In the early part of a couple of years, it grew very slowly because it was perfecting the model, the mistakes they were making, they were correcting it. And I think finally they did a very good job. They are the only retailer who's actually cracked the women's wear and the children's wear market through their West Side stores. Then they did it successfully, with Zudio, which was their another value format. They did phenomenally well. In the near term, if you look at it on very traditional metrics, it is very difficult to kind of value this. Yes, the stock is expensive and, given the kind of impact the pandemic has had on these kind of retail businesses. But I think these kind of businesses you buy not for a year, 2 years, you buy these businesses for 5 and 10 years to make money. We've held it for many years and, we intend to hold it for many, many more years. I think they are one of the survivors and thrivers of the coming retail boom in this country.
Great. Hiren, closing comments. I'm going to use Adani Group of companies just as an illustration. They have a lot of debt in them, but yet they've been massive wealth creators. You spoke about metals. Metal companies have a lot of debt in them, but you still like them. Now, for the better part of the decade gone by, we've used the following line: avoid companies which have debt, avoid companies which have a leverage. Somehow, I'm getting a sense that fund managers and money managers like you are not averse to buying companies which have debt or which have a leverage.
So, Nikunj, I think the trick there is you need to understand what the future business plan is. So, I would avoid investing in a business which is planning to grow by taking on more leverage. I think the Tata Group has made it very clear, that they are basically on a deleveraging mode, right? So all expansion will only be made after the balance sheet is substantially deleveraged. So I think, and if you believe that there is confidence that you have that the management can successfully deleverage the balance sheet, then a lot of money can be made because in the enterprise value, debt shifts to market cap. Just like on the other side, when you're building up leverage and the cycle goes against you, then you see that essentially, debt becomes a larger part of enterprise value at the cost of market cap. So I think when you think about investing in companies which have leverage, you have to be extremely careful. And you have to have the confidence that the balance sheet is likely to be deleveraged. And I think, it's also about how much in your portfolio you invest in these kind of companies. So the trick is, how you manage your risk and how you choose your companies very well. So debt per se is not a bad word. We generally use that as broad guide rails to say that you don't want to buy companies which have too much leverage, because we've seen it in the past that leverage, kills you, because anytime you make a mistake or the cycle goes against you, it takes many, many years, and some companies don't even see the light of the day. But I think where managements have clearly laid down a strategy to de-lever the balance sheet and the core business itself is doing phenomenally well, then it makes sense, to invest. And also, I think, as I said, it's all about how you build your portfolio, right? You must control your risk within the overall portfolio to see how much or what proportion of these kind of businesses you're going to invest in the portfolio. So I think as long as you can, you can proportion that and manage your risk well, I think there is money to be made there.
Thanks so much for joining us this morning and for really talking to us at length about the kind of opportunities you see in the market at the moment.